All right. Hello, everyone. I hope everyone's doing well. This will be my third lesson on accounting. In my last lesson, I talked about current assets and current liabilities and net working capital as a whole. Today, I'll be going more into long-term assets and then some other non-cash adjustments that we need to make to correct the discrepancies between accrual-based accounting and cash-based accounting. So first, let's just review a little bit what the three statements are. First, we have the income statement, which just at a high level is all of the revenue that a business is bringing in, all the goods or services that a business is providing during a period of time, and then all the costs that the business is incurring during that period, whether it is directly associated to the revenue, cost of goods sold, things like SG&A, like marketing expenses or employee salaries or rent, depreciation and amortization, which I'll talk about a lot today, or things like interest expenses on a company's debt or taxes. Then you have the cash flow statement, which is basically just all of the cash inflows and cash outflows that a company has during a period. So all the money that is going in and out of the company, whether it's related to their core operations, investing in long-term and short-term assets and selling those assets, and or whether it's from financing, whether they're raising debt, raising equity, or potentially paying down debt or buying back equity or issuing dividends. All of these are affecting a business's cash flow because all of these cause cash to either leave or enter the business. And then lastly, you have the balance sheet, which is showing all of businesses' assets, things that produce future economic value, whether they are current assets, which are assets that can be liquidated into cash in less than a year, or non-current assets, which are assets that a company will have for longer than 1 year. Then you have the claims on a company's assets. These assets result in cash flows, and then the claims on these assets and their cash flows are a company's liabilities, which are just things that are owed to external third parties, whether that is accounts payable, where they owe money to vendors, deferred revenue, where they owe a good or service to someone that already paid for it, or it could be debt, for instance, where they owe, like a bank or someone else that owed them money, that loaned them money in the past. Then you have shareholders' equity, which is just all of the money that a business has raised through equity, and that goes into common stock and APIC, and then all of a company's cumulative earnings or profits, net income over time, minus all of the dividends they paid out, and then of course all the stock that they've bought back, which is called treasury stock. So these are the three statements at a high level. And today I'll be mostly talking about long-term assets. Before that, I have not talked about these non-GAAP terms yet. If you look at people talk about finance, they use these terms a lot, like EBITDA, EBIT, EBT, and I just wanted to explain these in the context of the income statement because they are used a lot. EBITDA is just an acronym for earnings before interest, taxes, depreciation, and amortization, and is often used as a proxy for cash flow. People oftentimes like to compare companies using their EBITDA rather than their net income because they think that it's a better comparison because things like interest expense, taxes, and depreciation are kind of arbitrary, right? People, if they really just want to look at how a company is operating, probably wouldn't care how much taxes they're paying or their interest or their depreciation because it's just non-cash. Things like taxes are more related to the jurisdiction within which a company operates. Things like interest are more related to where a company gets its capital from, whether it's equity or debt, and then depreciation and amortization, of course, are non-cash. So those are the reasons why people would argue that it's better to use EBITDA than earnings, which is net income, as a way to look at how a company is doing operationally. People argue whether this is actually true. For instance, Warren Buffett is very against using EBITDA. He famously says that if he hears someone use the word EBITDA, he just thinks it means BS for a variety of reasons. For one, depreciation and amortization. The reason why a company would have high depreciation is because they have to make a lot of capital expenditures, and then those long-term assets are being depreciated over time. So perhaps depreciation wouldn't be irrelevant to a company's operations because it implies that they have to pay high capital expenditures. And then EBIT, earnings before interest and taxes. This is another one of these metrics you can use. This is obviously accounting for D&A. This is just net income plus taxes plus interest expense, or revenue minus COGS minus OPEX or operating expenses. You could go either way on this. And earnings before taxes, that's just the same as pre-tax income. It's just your earnings before the tax you pay. And EBIT is pretty much also the same as operating profit. So when you hear operating profit or operating income, just know it's pretty much the same as EBIT. And then EBITDA is basically just operating profit plus D&A, or your revenue minus COGS minus all of your operating expenses that don't include D&A. Because D&A, of course, is an operating expense. It's just non-cash. So moving on from that, I just thought it'd be important to let y'all know about these non-GAAP terms because they're used a lot. So we'll get into long-term assets today. So last time I talked about current assets, current assets and current liabilities and net working capital, and how these operating working capital line items kind of occur because of the discrepancies between cash basis and accrual basis accounting. And while a company oftentimes does have a lot of these current assets just due to how they operate, what really drives value for companies is long-term assets. For a company to really exist and operate over time, it needs to have long-term assets, like intangible assets like brand name, patents, or trademarks, or tangible assets like factories or airplanes, machinery, furniture, and land. These things are helping result in future cash flows for companies. And when companies purchase these long-term assets, that it will use for its core operations for longer than a year, this is called a capital expenditure. And when a company buys, a piece of equipment, something tangible, something that would be a capital expenditure, what shows up on the balance sheet as the asset they just bought is exactly what the value of the asset is that they purchased it for. So it's the purchase price that they paid. And then whatever they buy will be depreciated or amortized over time on the balance sheet. So I gave the example in my analyst group yesterday. If I buy a house in Austin for $1 million, and then 6 months later, it's worth $2 million because of the way that the housing market has performed in Austin, it would still show up as $1 million on my balance sheet. It's whatever you paid for it. That's called your gross PP&E, whatever you paid for it. And then obviously that house will be depreciated over time because we assume that I can only use that house for a certain useful life. So I'll get into that now. So net PP&E is what you would say is the book value of an asset on your balance sheet at a certain point in time. So you have your gross PP&E, which is whatever you purchased an asset for, minus the accumulated depreciation. So this is just all of the depreciation that a business has incurred for a particular asset. And the way that you calculate depreciation expense is by looking at that piece of equipment's useful life and then salvage values. Useful life is just how long the business will be able to use the asset, and salvage value is how much cash the business expects to get for the asset after its useful life. For instance, maybe let's say that house I bought for $1 million has a useful life of 10 years, and we could say it has a salvage value of $600K. That means after 10 years from now, the time I'm going to live in the house and use it as an asset, I could sell it for $600K, meaning that it's going to go from $1 million to $600K. It's going to be depreciated a total of $400K over that time. So that means, given the salvage value and the useful life, it's being depreciated a total of $400K over 10 years. That means that each year, assuming straight line depreciation, which is the most common depreciation method, where we're depreciating it by the same amount each year, going from 1 million to 600K, 400K total depreciation, we would depreciate that asset by 40K each year. And that makes sense, right? We're depreciating it by a total amount of 400K over 10 years, so 40K a year. So your gross PP&E would be 1 million. And then if it's the end of those 10 years, you would have accumulated a total of 400K of depreciation. And now your net PP&E would just be 600K, whatever the salvage value is, because it's the end of the useful life. So I guess I'll give another example here to show this. Let's say I buy a factory for $100 with a useful life of 10 years and a salvage value of 20. What will the yearly depreciation be for this asset? So, well, you can just do the same calculation. You can do what you bought it for, your gross PP&E, minus the salvage value. So $80. This is the total amount it will be depreciated over this 10-year period. So 80 total depreciation amount over the 10-year period divided by 10. That means we're going to incur $8 of depreciation each year. So your net PP&E at the end of the year one would be $92. Remember, net PP&E is just whatever the book value of the asset is at a certain point in time. So if it's been a year, that means this asset has gone down in value because it's depreciated. So now it'd be worth $92. Gross PP&E would be 100, and then accumulated accumulated depreciation would be $8 because we accumulated a total amount of $8. At the end of year 5, net PP&E will now be 60. Your gross PP&E, which never changes because it's just the purchase price at which you bought an asset for, still 100. And accumulated depreciation would now be $40 because you've incurred $8 of depreciation for 5 years. So that's why your net PP&E would be $60. So that's kind of the mechanics behind how net PP&E works and how we can figure out what the book value of an asset is at a certain point in time. You're always buying it for a certain amount, your gross PP&E, and it's being depreciated over time. So what happens to the 3 statements when the value of long-term assets doesn't go as planned? For instance, if a business sold an asset that had a book value of $50 for $100, then the balance sheet would not balance, right? I'm selling something worth $50 on my balance sheet, but I'm getting $100 of cash for it. So that means that my balance sheet is not balancing, right? My assets are going up 100 and then down 50. So it clearly does not balance like it always should be. So there needs to be a solution for that, and it doesn't work here. Or what if one of my assets burns down or just went down a lot in value? The balance sheet would also not balance, presumably, right? If I had a building worth $100 on my balance sheet and then it burned down and now it's worth $0, my assets just went down 100, but my liabilities and shareholders' equity didn't go down, and I didn't get any cash for it. So presumably, how does this work? Or what happens if I'm a business and I want to acquire another company and I pay a large premium to buy their company because I really like the idea? Maybe I'm, Mark Cuban on Shark Tank, and I buy a company that doesn't really have many assets, but I buy it at a large premium because I really like the guy who founded it, and I think it one day could turn into a big idea. Then I'm not receiving as many assets as the amount of cash I'm paying because I paid a large premium for it. So you can see here, these are all creating these kind of accounting errors. So now I'm going to talk about how the mechanics of all these things actually work. Because of course the balance sheet will always balance. These are not actually errors, but I'll show you how in practice this actually works. So first, I'll just do the first scenario, a gain or a loss. This is when a business sells a long-term asset at a different price than its stated book value. And this must be reflected on the income statement between operating income and pre-tax income. So this makes sense to us, right? If you have a gain or a loss, where this happens a lot, right? You're not always selling assets for the same amount as it showed up on your book exactly. That'd actually be pretty rare. Usually there's a gain or loss associated with, a sale of an asset. So when this happens, you need to reflect it on the income statement. And then as a result, you will be taxed on that gain or loss. However, because a gain or loss is more so related to a business's investing activities, it is subtracted or added from cash flow from operations and shows up in cash flow from investing instead. It's important to note, just like the reason why when we sell like a factory or a long-term asset, it doesn't show up on our revenue because it's not related to our core operations. Your revenue is not just all the cash that you're getting, it's only the goods or services that you're providing as it relates to your core business operations. So if I'm a, let's say lemonade stand company, and I sell like a parcel of land that I happen to own that I got from my grandma as an inheritance, this would not go toward my revenue because it's clearly not related to my core operations. However, maybe if I was a land selling company, it would go toward my revenue. But typically, like selling these long-term assets would not go toward your revenue. So I'll show you how it happens in practice. Let's say I sell a factory for $150 and the net PP&E, the book value on the balance sheet, was $100. So this gain will show up on the income statement below operating income. The reason it's below operating income is because this gain or loss is not related to your operating activities. It's more of an external random event, I would say, not related to your operations. Selling this factory is not actually what your business does. It's not your core operation. So you had a gain of $50, so that will go below your operating income and then increase your pre-tax income by $50. But you have to get taxed on this gain. So you'll pay $20 in taxes, assuming a 40% tax rate. 40% of 50 is 20. So your net income is $30. Then you go to cash flow from operations, and your net income, which is always the first thing we have in cash flow from operations, is 30. Then we are actually going to subtract this gain because this gain was not related to our core operation. So it's going to be 30 minus 50, and then it equals minus 20. You might be wondering, Carter, it's minus 20, but none of this was related to my operations. Like, this is kind of unfair. I lost money here. Well, technically, taxes are related to your core operations, even though it came from something that wasn't. It's kind of a weird concept, but that's just how it works. So your net change in cash from operations is down by $20. But then you also have the proceeds from the sale of the long-term assets. This is just whatever you sold it for. So in this case, it'd be 150. Whether it was a gain or loss is irrelevant. What is relevant is that you sold this asset for a certain amount of money, so that must show up in cash flow from investing because it's related to the sale of long-term or short-term assets. So you get $150 cash inflow, so your total net change in cash is $130. And this kind of makes sense, right? I'm selling this asset for $150, 100 of which was just the book value, and the other 50 of which was a gain, which must be taxed, right, at 40%. So that means I got $130. So intuitively, this all makes sense. Just remember, you have to actually subtract that gain from cash flow from operations because it wasn't actually related to your core operations. Whatever the sale of the asset goes, no matter if it was a gain or loss, goes in cash flow from investing. And that's a cash inflow, of course. Then we go over to the balance sheet. As always, first you show your cash. Your net change in cash was 130, so your cash is up by 130. And then your net PP&E is down by 100. It's important to know it's down by 100, not 150. It's down by whatever the stated book value was. So at the beginning of this period, it was stated to be worth $100. So you subtract your net PP&E by 100. So your total net change in assets is 30. And then your shareholders' equity, your retained earnings, is also 30 because it's just whatever your net income was. Because remember, retained earnings is just your cumulative profits minus your cumulative dividends. So if you had $30 of net income, this would increase your retained earnings by 30. Now I guess I'll go through the example of if it was a loss. Let's say, I don't have it actually right now here, but I'll just go through it in my head. So let's say it was the same book value of 100, but I sold it for $50. Then instead of a gain, it would be a loss of -50. So my pre-tax income would actually be down by -50. And because my pre-tax income is decreasing, I don't have to pay as many taxes, right? So that means that in reality, I would pay like positive 20 taxes. I wouldn't technically get money, but I'm actually paying less taxes. If all of a sudden my pre-tax income went from, like, maybe I'm a business, it went from 100,000 to 99,000 and $950. It went down 50. Now I would get to pay $20 less in taxes. I think that concept makes sense. So I don't want to over expand on that. But basically your net income would be down 30 now instead. Then you don't go over to cash flow from operations. Your net income is down by $30. And then you actually add back this loss because this was completely non-cash, right? This is like irrelevant to your, I would say better, it's not related to your core operations. You should just add this back here. In reality, you just sold an asset. You didn't lose any money from that. You're actually making money. So you would actually just add back this loss. So it'd be -30 plus $50. So your net change in cash from operations would be up $20 to reflect this kind of tax shield. And then your cash from investing is just $50 because you sold the asset for $50. So the total net change in cash is $70. And this makes sense, right? You're selling the asset for $50 and you got the $20 tax shield. So you move over to the balance sheet. Your cash is up by 70, but your net PP&E is down by 100 still because the book value of the asset was 100. So then your net change in assets was down 30, and your retained earnings is also down 30 because you had -30 of net income. So hopefully that makes sense. Now let's talk about asset write-offs and write-downs. These occur when the value of an asset has significantly changed from the value reflected on the balance sheet. And this can happen with both tangible and intangible assets. A write-off is when the value of an asset is completely written off your balance sheet. It's deemed to be zero. For instance, if maybe like a factory burned down. Whereas a write-down is just when the value has gone down somewhat, but not down to zero. It's not completely written off. So I'll give an example here. Let's say I have a factory worth $100 and it burns down. And it was worth $100. Oh, sorry, I skipped ahead accidentally. And it's worth $0. Unlike a gain or loss, an asset changing in value is completely non-cash, right? Let's just think about this like a 5-year-old. If my apartment room just completely burned down right now, I would not lose any money from that. Yeah, I would lose my apartment, and that would suck, but I wouldn't actually lose any money. No one's taking cash from me unless, there was cash in my apartment. But in reality, like, I'm not actually losing cash. So unlike a gain or a loss, an asset changing in value is completely non-cash. When you actually sell an item, there is cash being exchanged here. But here, there's no cash being exchanged. So this means it must be added back in cash flow from operations because no cash actually left, my pocket. So same thing, it's below operating income on the income statement. It must be reflected on the income statement. Below operating income is, of course, this is not related to your core operations. Your asset burning down is not because your operations went wrong. It's just because of this like random event. It's not related to the goods and services that you actually focus on providing. So this asset write-off would be down negative 100, so your pre-tax income would be down 100, and then as a result, you would pay $40 less in taxes because your pre-tax income has decreased. In reality, there's a lot of tax rules for this, so I don't know if that is necessarily true. I actually discovered this a few weeks ago, and a lot of people don't know that, but don't worry about that now. Just assume for these problems that you would be basically having a tax shield here. So basically, your net income would now be down $60. Then you go over to the cash flow statement. Your cash flow from operations, your net income is down by $60. That's what you always put first there. But then you need to add back this asset write-off because it's non-cash, of course. So your net change in cash from operations is 40. So when I say think about it like a 5-year-old, it's a bit hard because I don't think a 5-year-old would be able to consider there's like a tax shield there. But just know that it would be positive $40 actually because you're actually paying less in taxes than you would have otherwise. So your total net change in cash is $40. Your cash is up by 40. Your net PP&E is down by 100. So your net change in assets is down 60. And then your shareholders' equity, your retained earnings are down by 60 because your net income is down by 60. So that's how an asset write-off or write-down works. Similar mechanics to the gain or loss. It goes below operating income, and you need to add or subtract it in cash flow from operations because it's not related to your core operations. So now let's look at goodwill. This is probably the most confusing of these. It's when companies acquire one another. Oftentimes, the acquirer pays a premium for the acquiree, the target company, to gain full control. Oftentimes in M&A, mergers and acquisitions, companies will pay a premium for each other to incentivize the owner of the company they want to take over to actually sell them their company. And oftentimes, this creates an accounting gap where a company is paying more in cash than the fair value of the net operating assets that they're receiving for acquiring the company. So maybe I'll pay $1 million for a company worth $700,000 because I really, really like that company. That creates an accounting gap, right? Because I'm paying, $1 million for something that's only worth $700,000. And with companies, it's more important. If I just buy a factory, we don't plug in this goodwill amount here. We don't deal with that issue. We just assume we buy things at the fair value. But with companies, it's definitely more noticeable. I can't just buy a company and then just assume that I bought that company for a fair price. We need to show this accounting gap here because if you think about it, if I acquire a company that just has assets that are specifically worth a certain amount, I can't just change the amount of them just because I bought them for a price that was higher than that. That's unrealistic, and it kind of isn't showing investors of that company the full picture. Hopefully this example will help explain what I'm saying. For instance, Amazon bought Whole Foods in 2017 for $14 billion, but only $5 billion of that $14 billion was actually going toward the net operating assets, the fair value of the net operating assets that Whole Foods had at the time. So this is creating an accounting issue, right? I'm paying $14 billion for something only worth $5 billion on the balance sheet. So as you can see, the equation here is not balancing. So as a result, I'll create this asset of goodwill, which is an intangible asset that reflects, for some reason, this company thought this target company warranted a huge premium for it. So goodwill would be created here because I want to have control of Whole Foods. I'm willing to pay a premium for it. So as a result, this goodwill is created. So this kind of plugs in the income statement or the balance sheet, as you can see here. I'll talk about an example in a second. So Goodwill Impairment, oftentimes acquisitions won't go as well as the companies initially thought they would. And rather than Goodwill Impairment, Goodwill is the asset. It's an intangible asset. And rather than it being amortized like most intangible assets, companies don't do that. They're required to perform annual goodwill impairment testing to see if their balance sheets still reflect the fair value of its goodwill. This is kind of complicated and really kind of more of an art than a science. It's really hard to like tell if like a company you acquired, the Goodwill, this premium you paid was actually worth it or not. So this testing, honestly, I don't know the full dynamics of it, but oftentimes if an acquisition doesn't go well, maybe Amazon bought Whole Foods because Whole Foods is very like organic. And then a scandal comes out that Whole Foods isn't actually as organic as they say, and people stop wanting to go there. Maybe Amazon would then perform a goodwill impairment where they're impairing their goodwill. They're saying actually the value of our goodwill, it says it's worth 9 billion, probably only worth 8 billion because of this scandal that's gone on. And when this happens, similar to a gain or loss or an asset write-off or write-down, this will be reflected on the income statement. Sorry, when goodwill is impaired. So you have a few examples of that. So let's say I acquire a company for $100, and the company has net operating assets, which just operating assets minus operating liabilities with a fair value of 70. Let's say accounts receivable is 10, inventory is 20, PP&E is 50. So it has it has operating assets of 80, and then operating liabilities of 10, accounts payable of 10. So your net operating assets is 70. But I just acquired this company for $100. So how will this affect my three statements? Right, I'm paying $100 in cash for something only worth $70. So what would happen is my assets would go up by $10. I'm acquiring $80 of assets, and then there's $30 of goodwill to fill in this plug. $170 of net operating assets, the $30 fills in that plug. So it's going to be 80 plus the 30 of goodwill minus the $100 in cash, and then plus the liabilities. But the liabilities will go up by 10. I've like taken on their accounts payable. And my shareholders' equity will be unaffected because it's not affecting my net income and I'm not getting new capital from it. So this is how goodwill kind of gets created. It's when you buy a company for an amount that's higher than the fair value of the net operating assets. So here's how goodwill impairment works. Maybe, I bought this company and there's $30 of goodwill created. Maybe something happens with this acquisition. It doesn't go very well. And I perform goodwill impairment testing and I decide that we're going to impair the goodwill by $10. So similar to an asset write-off, this is completely non-cash and not related to my core operation. So it will make my net income go down by $6, but I need to add back this goodwill impairment because one, it's non-cash and it's also not related to my core operations. So my net change in cash from operations will be $4. Let me go over to the balance sheet. My cash is up by $4. Cash is up by 4. Goodwill, this intangible asset, is down by 10. Your net change in assets is 6, and the net change in shareholders' equity is also down 6 because net income was down by 6. So this is how goodwill impairment works. It is kind of a confusing concept, but just know when goodwill is created, it doesn't affect the income statement. It's only when this goodwill is impaired, similar to a gain or loss or asset write-off, when this would actually affect the income statement. So lastly, just a few other non-cash adjustments that we need to account for in cash flow from our operations. I've already talked about a few of them, like depreciation or like an asset write-off or write-down or goodwill impairment, for instance. But there's a lot of other adjustments we need to make in cash flow from operations. We have stock-based compensation. I'm not going to go into all these in detail because they're a bit more complicated, but I just want to tell you what they are so you kind of know and can recognize the principle. Stock-based compensation is when a company pays their employees with future stock in their company rather than cash. This will show up as an expense on their income statement. However, it's really non-cash. So what will happen is you need to add back that into cash flow from operations because it's non-cash. This expense is decreasing your net income, but in reality, it's non-cash, so you need to add it back. Similarly, PIK interest is when you have interest expenses, but you don't pay them in cash. You defer paying them. You say to your lender, hey, I'm not going to pay you this time. Maybe next time I'll pay you more because of that. It's basically saying I'm not going to pay you now. It's like deferring the payment. And while you are incurring that interest, it actually is increasing the amount you're going to have to pay in the future. It wouldn't be cash, right? You're not actually paying cash interest. So you need to add that back as well because it says you're incurring interest, but you're not actually paying it in cash. And deferred tax assets and liabilities, this is the same thing. Sometimes you pay more or less than the actual amount of taxes you were supposed to pay that it shows up on your books. Sometimes maybe I have on my book, on the income statement, it says I paid taxes of 10, but I only paid taxes of 5 because I paid less taxes than I was supposed to. This creates a deferred tax liability where I'm going to owe future taxes in the future. But in reality, this was non-cash. In this period, it said I incurred $10 of taxes, but I only actually paid 5 of those. So I need to add back these taxes that I did not pay. And same thing with deferred tax assets. This is when I'm paying more in taxes than I actually was supposed to. And this would actually decrease my cash flow from operations, because in reality, I paid more cash than the income statement reflects. So here's like the full formula for cash flow from operations. We have our net income, and then we add back the